You are most welcome again to MAT Abacus Business School, and today we're going to continue from where we stopped in episode 1, where we looked at the structure of the examination, and specifically we also looked at about 3 topics. We looked at taxation of business income. We also looked at taxation of employment income and VAT. So these ones, we looked at them and we say that business income is normally in question 1 and takes 40 marks. But then also we said that they can also examine partnership income. They can also examine partnership income, which we are going to look at today in this session. We also mentioned about employment income and value added tax. For this particular session, we're going to focus on 3 areas. We're going to focus on customs management. We are going to focus on partnership, taxation of partnership income. We're also going to look at taxation related to capital gains tax, normally abbreviated as CGT. Now, we're going to start with customs management. Customs management. One, what you need to know is that taxation related to customs is normally on imports and exports. Imports and exports. If you import goods or services into the country, how much tax do you pay? How much duties do you pay? That would be the focus for this particular topic. But most importantly, the focus is mainly on imports, because as the East African Customs Management Act, as the government of Uganda, the major focus is on how much tax are you going to pay for people who bring in goods or services in the country. So the focus will be on imports and less focus on exports. Now, what you need to note is that the customs management is guided by the East African Customs Management Act, IACMA. Is guided by the East African Customs Management Act of 2015. Now, this act is the one that specifies how you tax. And this is just the narrow bit of it. But on a global scene, customs are guided by the World Trade Organization and World Trade Organization, WTO. So what we need to note is how do we tax. Now, as you are taxing, you need to compute what we call the customs value. You need to compute what we call the customs value. Now, for you to compute that, you need to put into perspective how are these goods getting into the country. So I'm going to give a scenario where goods are from China. Before they reach China, they reach the port of Mombasa. Now, this port of Mombasa is where the goods will first reach before they are cleared into Uganda. Then the goods come to Kampala, Uganda. Now, when they are from China to Mombasa, there are some costs you incur along this line. So you have to incur some costs. Some of the costs include the cost of purchase, and then cost of transport, cost of clearing, all those costs. Now, these costs are included in CIF. So we say they are CIF included. The examples we are saying, we are talking about those costs. Now, we have costs that are incurred from Mombasa to Kampala. So now, these costs are CIF excluded. CIF excluded. Now, so these costs we are saying, we have the cost of purchase. So the cost of purchase forms part of that. You may have royalties. You may have cost of transport. Cost of transport. Now, this cost of transport is inside what you are incurring while before the goods have reached Mombasa. Then cost of loading and unloading. Then you may have the cost of non-returnable container. So the returnable containers, their costs are excluded. So here you may have cost of returnable containers. The cost of returnable containers. So if the container is returnable, it means you have not incurred the cost, because this is you are going to return this container. So then there is no cost to the importer, and because of that, then you cannot pay tax on it. Then there is cost of transport. So if there is any cost of transport, I'm putting cost of transport in either side, but this cost is in China before the goods reach the port of importation. So the cost of transport is, let's say, from Mombasa to Kampala. So the cost of transport from Mombasa to Kampala is not included. Now, if there is any other cost, the cost of clearing, that is also not included. There is what we call demurrage fees. Demurrage fees. So demurrage fees, when goods reach the airport, they are given a number of days for them to be cleared. Let's say they are given 21 days. Now, if the importer does not clear them within this specific period of time, then they will attract charges, and those charges are called demurrage fees. So those ones are incurred at the port of importation, the port of Mombasa, and they are not supposed to be included in CIF. So that is the general thing that you need to master on computation of import duties. Now, the other thing you need to note is freight. Like I said, freight does not only mean air transport, but students normally confuse this and they say freight is transport by air. Now, freight includes air transport, includes water transport, includes railway transport, and it includes road transport. All this may be categorized as freight. Now, for customs purposes, air transport is not included in customs valuation. Not included in customs valuation, but water transport is included, railway is included, and road is included. So you have to note that. And now, in some other cases, they may give you what I gave you from China to Mombasa to Kampala. So you may find the air transport is from China to Kampala. We've said that the whole of air transport will be excluded. The whole of it will be excluded. But now, when there is insurance, the insurance from China, because we said costs that you are incurring after they have reached the port of Mombasa, after this port, they are excluded. But in some cases, when the insurance is from China to the port of Kampala, then you include the whole cost of insurance. But then the examiner may split the insurance and say insurance from China to Mombasa. So this one you include. But if there is insurance Also from Mombasa to Kampala, this one is not included. It is not included. But then there are so many other scenarios that you may look at. But the general rule is costs incurred after the port of importation are excluded, and costs incurred before the port of importation are included in customs valuation. Now let's look at the template. Template for customs value computation. So we are looking at the template for customs value computation. Now, one, we are going to look at details, look at computation, then amount, and the comment. So here, what you include here is the details like the cost of goods. So let's say the cost of goods was 2,000, so you get 2,000 times the exchange rate, 2,600. I mean 3,600 if the goods are given in foreign currency. Then you get the value here. And now the value, if the cost is included, you include it under amount. Then you say CIF included. Now, if the cost is not included, let's say freight by air, and let's say it is 1,200, so you multiply by 3,600. This exchange rate is given, so you don't have to. This exchange rate is given, and then this cost is given. Then the cost is that. So then you say this is, if it is excluded, then you do not put the value here, you put a dash. But then you have your value here, so the examiner will give you a mark. Then you say CIF excluded. Now, the common mistake students do is that when the cost is excluded, they ignore it. Ignoring it means you are ignoring marks. So you need to include it, so that you need to write it so that the examiner knows you know it is excluded. So you do not ignore it. If let's say there is the cost of returnable container, we say the returnable container is excluded. Let's say it was 1,000, so it will be 1,000 times 3,600. You get the value here, and then you exclude it, because the returnable is excluded. So you say CIF excluded. If we have non-returnable containers, so non-returnable containers, let's say it is 800 times 3,600. This one is included. So you say it is CIF included. If there is insurance, let's say insurance was 3,000, you multiply by 3,600, then this one is included. You say CIF included. If transport from Mombasa to Kampala, this one is, let's say, this one they normally give it in Uganda shillings. Let's say it was 2 million. So it will be excluded. CIF excluded. So, following the general rule, depending on what the examiner has examined, then you add these ones. And you say this is the total customs value. Total customs value. So it is based on this value, the customs value, that we now compute the taxes And how do you compute the taxes? So let's look at tax payable. Computation. Tax payable computation. So there are there are major taxes that you need to compute here. One, we have import duty. Import duty. So the import duty is equal to the CIF. Now this customs value can be abbreviated as CIF. Customs cost, insurance, and freight. So it is CIF times the import duty rate. Import duty rate. The examiner normally gives the import duty rate as 25%. But now it would also be different depending on what they have examined. Then the second one is called VAT. Now VAT is CIF plus import duty times 18%, because the VAT rate is always standard. It is 18%. The third one is withholding tax. So withholding tax is CIF times the withholding tax rate. Now the withholding tax rate, like we know, is always standard, so it is CIF times 6%. So the withholding tax rate is on importation is 6%. And the fourth one is infrastructure levy. Infrastructure levy. So infrastructure levy is CIF times the infrastructure levy rate. And the rate is always is normally given as 1.5%. So it is CIF times 1.5%. So these ones, they may change, so you have to look at what the examiner has given in the question. Then after that, you get the total tax payable. Total tax payable, and the total tax payable will be the addition of import duty plus the VAT plus withholding tax plus infrastructure levy Then you get the total taxes to pay. That is measured about customs, and when this is examined, they normally examine the computation part, which takes around 10 to 13 marks, and the next they also examine the theoretical part, which takes about 8 to 10 marks, depending on the distribution. So as you are doing this, you also need to practice areas of theory and be able to so that you are able to answer this question on customs management. The other area that we need to look at is called capital gains tax. Capital gains tax. Now, capital gains tax is abbreviated as CGT. The capital gains tax. Now, a capital gains tax, it is tax that is charged on disposal of business assets. And in Uganda, the capital gains tax is not a separate tax. It is combined with business income. So whenever you have a business and you sell a business asset, you get a gain. Then that gain is aggregated with other incomes and is taxed at 30%. The tax rate is 30%. So key things to note is that CGT is not a separate tax. It is not a separate tax. It is combined with business income. It is combined with business income. So it is not a separate tax. It is not a separate tax head. The other thing you need to note is that it is the tax rate is 30%. Tax rate is 30% because business income is taxed at 30%. Now, how does it arise? We are saying it arises when you have disposed of the asset. Upon disposal of non-depreciating assets. Non-depreciating assets. Now, it happens when you dispose of. When you dispose of an asset, you get a gain or you get a loss. In accounting, we say you get a gain on disposal or a loss on disposal. And a gain on disposal happens when, in accounting, when you dispose of an asset, you either get a gain on disposal when the disposal proceeds are greater than the carrying value of the asset. And you get a loss on disposal when the disposal proceeds are less than the carrying value of the asset. For tax purposes, this gain on disposal is not income which is supposed to be taxed. So therefore, it should be raised as an allowable deduction. It is raised as an allowable deduction, and we say that it is not taxable income. It is not taxable income. It isn't taxable income. Now, again, a loss on disposal is a non-allowable deduction. Is a non-allowable deduction. And it is added back. It is added back. It is an expense that is added back. So that is a loss on disposal. That is for accounting purposes. And these ones are determined using the International Financial Reporting Standards. But for tax purposes, so the taxman is going to compute gain or loss on disposal using the following. So for him, he gets what we call the capital gain. For him, he calls it the capital gain. So the capital gain is when the proceeds are greater than the tax written down values. When the proceeds are greater than the cost base, we call it cost base of the asset. So the cost base of the asset, when the cost base, now the Income Tax Act defines what is cost base and also defines what is proceeds. Now, why it is computed like this is that in some cases, the cost base or the proceed is not at arm's length transaction. So therefore, the taxman will disregard either of the cost base or the proceeds and will consider what we call the fair market value. That's why we may use this. Then the second one is the capital loss. The capital loss is when the proceeds from the disposal of the asset is less than the cost base. So the cost base is more than the proceeds. So here we get the capital gain. The capital loss. Now, for tax purposes, the capital gain is added back. It is taxable income. It is taxable income. And because it is taxable, it is added back. It is added back. So it is added back to be taxed. And the capital loss is an allowable deduction. It is an allowable deduction. Because it's an allowable deduction, it is less. It is less. It is less. It is less. So that is a brief summary of non-depreciable assets. Now, how this can be examined is when the examiner has given you a disposal of a roads vehicle. A disposal of a roads vehicle. Now, this roads vehicle is a Land Cruiser. It is a Land Cruiser V8 that was purchased for the MD. And it is being disposed of So for you to dispose of, you need to consider three things. One is, what was the cost of the vehicle? The cost of the vehicle. So the cost of the vehicle was 250 million. It was purchased in January 2022, right? It was purchased in January 2022. It is being disposed of in December 2025 at 180 million. So the examiner is asking you, is there a gain or loss on disposal? So now when this vehicle is given, one, you need to consider two things. One is, what was the cost? Okay, before you go there, you need to split this vehicle into two assets. So you have the vehicle, you need to get the two assets. You need to get two assets. So this is the asset, which is the motor vehicle. And we're saying it has two assets. The first asset is a depreciable asset. I'm calling it DA. And the other asset is a non-depreciable asset. So the depreciable asset, as per the tax laws, it is maxed at 60 million. It is maxed at 60 million, and the difference is the non-depreciable asset. So meaning that of the cost, which was 250 million, we get 250 million minus the 60 million. So this one will be 190 million. So this one will be non-depreciable asset, and this one will be a depreciable asset. Now, these ones have different tax treatments. First, a depreciable asset is included in wear and tear schedule. Included in wear and tear schedule. Two, it attracts what we call a depreciable. It attracts what we call a balancing charge. A balancing charge. And it can attract what we call a balancing allowance. I'm going to explain this. Now, a balancing charge is when the tax written down values in a class of an asset are less than the proceeds. Meaning that you dispose of assets and you get more money than what is on the face of those assets. Now, when that happens, you get what we call a balancing charge. So the difference of this is called a balancing charge. The other way is when you have a balancing allowance. A balancing allowance is when the tax written down values are greater. So tax written down values here are greater than the proceeds. So when the tax written down values are greater than the proceeds, but the difference is less than $1 million. The difference is less than $1 million, less than 1 million. Then we say we have a balancing allowance. So the difference is a balancing allowance. Let's say it is 990. So this one will be a balancing allowance. For tax purposes, the tax treatments are that a balancing charge is income and should be taxed. So it is income and should be taxed. So therefore, since it is income and should be taxed, it means it is added back. And given that we said that capital gains tax is not taxed on its own, it will be added back in the computation of business income. So it will be added back as a non-allowable deduction. So it will be added back as a non-allowable deduction. But a balancing charge is an allowable deduction. So it is an allowable deduction. and it will be less. It is considered as an expense which is allowable for tax purposes. That is the result of the depreciable asset. Now, what about a non-depreciable asset? Non-depreciable asset. So the non-depreciable asset is an asset that is in excess of the 60 million when it is a road vehicle. Now, for it, so we said, you said that the asset was 250 minus 60, so the cost of the asset is 190 million. Now, for it, you need to depreciate this. So this one is depreciated. Is depreciated to get the cost, the cost base. And now the proceeds are also apportioned. The proceeds are apportioned. So you get the proceeds. You get the proceeds. So you get 190 million divided by 250 million times the proceeds, because the proceeds we said were 180 million, times 180 million, and you get how much are the proceeds. So you compare the proceeds and the depreciated cost, and then you see whether you have a gain or loss. The difference is a gain or loss. So it becomes a gain when the cost is less than the proceeds, and it becomes a loss when the proceeds are more than the cost base. And the difference is taken. If it is a gain, it is added. We call it a capital gain. It is a capital gain. It is added to the gross incomes. To the gross incomes. In short, you add it back. So you add it back to the PBIT. If it is a capital loss, we say it is when the proceeds are less than the cost base. And this one you consider it as an allowable deduction. You consider this as an allowable deduction. And you put it in the computation. So that is the summary of the capital gains tax. But of course, when we're in a class setting, and we're in a class setting, we have these have detailed notes, and also looking at the computation of these in using the examination questions, so that you get a feel on how it is computed. And then also there are also many other ways how the examiner may ask this, that we can look at when we are in a class setting. And you can only do this when you come to MAT Abacus Business School. The other one is partnerships. So with partnerships, we are looking at taxation of partnership income. Now, what you need to note is that partners are guided by what we call a partnership deed. They are guided by a partnership deed. Now, a partnership deed is the same as a partnership agreement, and it guides how the partners will share the profits, how on the admission of partners, and on the exit or retirement of partners. It also includes many other things, including the capital contributions, the interest on capital, interest on drawings, and so many other things. But for this particular concept, there are specific things we need to note, the key terms we need to note. When a partnership is formed, it makes, because first of all, a partnership is an arrangement between two or more people with a view of making profits. So it is normally operated by professionals, the audit firms, the lawyers, and maybe the other professionals who may come together. They have different skills and they have come to do business. And the major aim is to make profit. Now, in partnership, we need to note keywords. One is that when a partnership is formed, the partners contribute capital. So they contribute capital. So this capital is very, very important. Now, this is contributed by partners. Now, this capital, because it's contributed by partners, the partnership and the partners, remember, are different individuals. They are not the same. So the capital will attract what we call the capital, will attract what we call interest on capital. It will attract what we call interest on capital. You have interest on capital. Now, interest on capital is treated as two ways. One, it is an income to the partners. It is an income to the partners because they contribute capital, and the partnership pays them on the capital they contribute. So it is income to the partners. And then two, it is an expense to the partnership. It is an expense to the partnership. Now, what you need to note is that this income is taxable to the partners. Taxable to the partners. It is taxable to the partners. It is regarded as part of the employment income, and it is taxable because we said that a partnership, as a general rule, does not pay taxes. So it's not like business income where the company paid tax at 30%. But the partnership will compute the taxable income, the chargeable income. After computing the chargeable income, we will distribute the income to the partners. Now, it's the partners themselves who will pay the tax. The partners themselves will be the one to pay tax. And they're paying tax based on the pay-as-you-earn rates. They're paying it as if it is employment income. So this is added to the partners, the income to the partners, the interest on capital is added to the partners' chargeable income. But the expense to the partnership, much as it is an expense to the partnership, for tax purposes, it is not an allowable deduction. It is not an allowable deduction, meaning that it is added back. It is added back. That is one concept. The other concept is that the partners will make what we call drawings. So the drawings are private expenses. The partners will draw money for their personal use. Once they make drawings, these drawings are not allowable deduction. So they are added back. They are added back. So they are not expenses that are allowable. They are added back for a computation of partnership chargeable income. Now, these drawings, they attract what we call interest on drawings. They attract interest on drawings. So the interest on drawings, there are things you need to consider. Interest on drawings is what the partners will remit to the partnership. Because they withdraw money, they are using it for their own things. Once they take that money, they pay interest on it. So they pay interest, they are paying it to the partnership. Therefore, the interest on drawings, given that it is money that is paid by the partners, it is income to the partnership. It is income to the partnership. And it is taxable income. It is taxable income. And once it is given to you, given that the exam already has the profit for the year, PBIT, you do nothing to it because it has already been included. Now, then it is an expense, because it is an expense to the partners. It is an expense to the partners. Now, because it's an expense to the partners themselves, it will be allowable to them. When they are computing the chargeable income, it will be allowable to the partners. It will be allowable to the partners when computing the chargeable income. When computing the chargeable income of the partners. Of the partners. So it will be a minus to reduce the income to pay, to reduce the income that is taxable. Now, there is another scenario when the partners give a loan. So there is a loan. Now, loan is of two types. One, we have loan from commercial bank. Loan from banks. This one is treated normally. The loan would be in the balance sheet. It is always on the non-current liabilities, and then the interest on the loan is an allowable deduction for tax purposes. Allowable deduction for tax purposes. But then also putting into consideration section 25, where we allow EBITDA 30% of the chargeable income. We cap it to 30% EBITDA of EBITDA. But the loan would be normally an allowable deduction. And then there are times when the partners, the partnership gets loans from partners. So when the loan is from the partners will earn income, which is called interest income. So they will earn interest income, and we're saying that this is income to the partners. So it is income to the partners, and because it is income to the partners, they have to pay tax on it. It is included in their chargeable income, and they are going to pay tax on it. And then it is an expense. So in the books it is called an interest expense to the partnership. So to the partnership, it will be regarded as an expense. And this expense is not an allowable deduction. Not allowable deduction. It is added back. Because it is not allowable, it is added back. That is another concept that you need to master under loans. So we looked at capital, where we look at the interest on capital. We have looked at the drawings. And then the other one we have looked at is called the loans. So the things you need to master when it comes to partnership. Now, the other thing you need to look at is salaries. Salaries. So in some cases, they may give you salaries. Now, salaries are of two types. One, we have salaries of partners and salaries of other employees. So the partnership may have other employees, and they may also have salaries of one of the partners who are very active in the partnership. So salaries of partners are considered as non-allowable deductions. They are non-allowable deductions to the partnership. To the partnership. there are non-allowable deductions to the partnership. But to the partners, it is taxable employment income, taxable income to the partners. So the partners, it will be included in their income. But then for other employees, it is allowable deduction. It is an allowable deduction. It is an allowable deduction to the partnership. It is an allowable deduction to the partnership if the salaries are related to other employees. Reason being, it is an expense that has been incurred in production of income included in gross income for the year of income in accordance with Section 22, subsection 1 of the Income Tax Act. So that's what you include in there. So having said all that, you need to look at the template for computation of taxable template for computation of partnership profits and distributable profits and distributable profits. Now, what is this about? Now, this one is about you need to now need to know how much profit has the partnership made and how much profit is distributable to each partner. So to do this is more or less like what we did under business income. You will start with profit or loss. Now this is as per accounts. So the examiner will give it to you. He will give you the income statement. So you'll have shillings here. You shall also have shillings here. If you want, you can put them in thousands. Then you add back. So you add back non-allowables. You add back non-allowables. So under non-allowables, you have what you call the accountant depreciation. That one is very automatic. You add it there. The accountant depreciation. You have interest on capital, because we said it is an expense to the partnership, but it's not allowable. Then you have partners' salaries. Partners' salaries, we say it is also not allowable in our preamble. Then we have drawings. Drawings, they are also not allowable. And then all other non-allowable deductions. Non-allowable deductions as per Income Tax Act. If there is any other expense that is not allowed for tax purposes, let's say you have fines, you have penalties, you have staff parties, you have capital expenditures, any other expense that would ordinarily not be allowed under business income is also not allowed here. Is also not allowable. Now, so then you add these here, then you less allowable deductions. Less allowable deductions. So under allowable deductions, the same way we looked at business income, you have capital allowances. So under the capital allowances, you have things like IBD, you have things like the wear and tear. And now when the examiner gives you this, the wear and tear, they do not normally add the many details. So you compute the wear and tear. And any other, all allowable deductions. All allowable deductions as per the Income Tax Act. they are also list here. So these ones include things like startup costs, include things like rental income, because according to Section 5 of the Income Tax Act, rental income is taxed separately, so you list it here. If there is income that is regarded as final tax, is interest income from treasury bills, it is listed here, or any other expense that is allowable for tax purposes. If there is an expense that was not considered by the accountant, and here you need to consider it, you list it there. Then you get this one. What you get is called chargeable income. Chargeable income of partnership. Chargeable income of partnership. Now, this chargeable income, you have to adjust it, because this is for the partnership. Now, you have to adjust it to the incomes that were earned by the partners. So you list to get how much is distributable to the partners. So one of them is interest on capital. Interest on capital. So adjust it with interest on capital, because this is income that has already been earned by the partners. Then the other one, you list partners' salaries. So you list partners' salaries. Partners' salaries. So partners' salaries, you also list it. Then you list drawings. You list drawings. Now what you get here is called distributable profits. Distributable profits. Now it is these distributable profits that you are going to share among the partners using their profit sharing ratios. So then you determine how much is each of the partners receiving. Now after you've gotten that, then you compute what you call the chargeable income. So we're going to look at the determination of chargeable income of partners. The chargeable income of partners, here you are now looking at how much tax will each partner pay. So you are going to look at partner A, B, C, and then the total here. So here you are looking at the profit share. So you are looking at how much of the profit that we computed above, how much is each sharing. Then you will add the salaries they earned, the partners' salaries. So you may find, let's say one did not earn salary, you don't put it there. If they earned, you put. Then the other one, they have interest on loans. They had interest on loan, they gave a loan to the partners. So you also add it there. How about if they had drawings? Drawings, they also be taxed on drawings, because it is income they earned through that. So which other thing can you add there? You may find there is any other income. If these partners are, so you may have foreign income. If these partners are resident individuals, they are taxed on worldwide income. So because they are taxed on worldwide income, if there is any income that they earned outside the country, is also will be added there. Then you get what you call the chargeable income. Now this chargeable income will be chargeable income of the partners. Then you will less tax credits. I mean, first of all, we first get the tax payable. Now this income, you are going to tax it using the tax bands. So we use the tax bands that are given at the back of the examination question. So the tax bands are given at the back of the examination question. So you check and see how much tax is paid by each band. So there you have 30%, I mean 0% for any person who earns income between 0 to 2,820,000. They pay 0% of the tax. Then income from 2,820,000 to 4,020,000, they pay tax at 10%. And any person who has income between 4,020,000 to 4,920,000, they pay tax at a rate of 20%. And incomes between 4,920 to 120,000, they pay tax at a rate of 30%. And then above 120,000, they pay tax at a rate of 40%. That one we looked at when we did employment income. So you tax them and determine the tax for each person. After determining the tax for each person, now it means this is the tax they need to pay. But then they may have paid taxes. So you raise what you call tax credits. Now tax credit is tax that is already paid in advance. So this is a tax you have computed for a year. But then you are like, there is already a tax which I already paid. So that one must be raised. And these taxes are raised in order. The first one you raise is foreign tax credit. Foreign tax credit. So the foreign tax credit reduces the tax payable. Reduces the tax payable. The next one is if you paid any provisional tax. But before that, you have to first raise the withholding tax credits. So after raising the withholding tax credits, you raise what you call the provisional tax. If you paid any provisional tax. Let's say now, your employer, your partnership was removing your pay as you earn. Because your salary is already included here. So your pay as you earn will be a provisional tax paid. Or any other provisional tax. That one is also raised. Then you, after raising that, you get what you call the net tax payable. Net tax payable. Net tax payable. So the net tax payable is what you pay. So key thing is to note, one, is that the partnership does not pay taxes. It is the individual partners pay taxes using the pay as you earn rates. So the partnership does not pay income tax, does not pay income tax. Then three is that the partners are the ones who pay tax. We say that the partnership does not pay taxes. Then the other thing is that the profits, the profits are shared according to the profit sharing ratios. And in the absence of a partnership deed that specifies the profit sharing ratio, then the profits will be shared equally among the partners. It will be shared equally among the partners. So majorly, that's all we cover under a snapshot of what we cover under CPA 11. So to do a small recap, one, you need to make sure that you understand the following topics, like we have covered them. One is business income, computation of business income, and the tax to pay. Then two, you need to master employment income, and then the tax to pay. Then three, you need to master what we call VAT, value added tax. Then five is customs management, And then 5, you need to ensure you understand what you call the capital gains tax. These are the major topics that are examined at CPA 11, taxation. In some other cases, we have what we call rental income, and then other cases there is what we call withholding tax. So the major topics that you need to master before you go to the exam. But then what we gave here was just a small like highlights, brief highlights of the paper. And all these topics are very comprehensive, and we can teach them to a student when they come for classes, and you can only get this when you come to MAT Abacus Business School. Thank you so much. Have a nice time.